Hey everyone, welcome back to Corporate Decoder, the place where we unpackage the financial mysteries that shape our world. And today we're diving deep into a thick SEC filing from Vanguard MALVERN funds that looks like a treasure trove of financial data. This report, it is basically a shareholder report for investment companies. And since we're all about understanding where money is going, it is going to be a fascinating look at some big funds. We're going to cut through the jargon and focus on the real story these numbers are telling us about how these funds are performing and what it means for you and me. So grab your coffee and let's decode this. We're going to break down some key performance metrics and financial highlights that tell us if these funds are making smart moves. And hey, if you like getting these straightforward insights from complex financial documents, make sure you are subscribed and join our Discord community linked in the description below. We're looking at Vanguard MALVERN funds, and they've put out their report for the period from the 1st of October 2024 to the 30th of September 2025. They manage a bunch of different funds, so we'll be touching on a few of them. First up, the Vanguard Short-Term Inflation Protected Securities Index Fund. This fund is all about protecting your investment from inflation, which is a big deal, especially with the economic ups and downs we've seen. They lay out the cost for a hypothetical $10,000 investment, and for the investor shares, it is a pretty small $14 that is like a rounding error for your portfolio. The cost as a percentage is 0.14%, which is really low. For the ETF shares and institutional shares, the costs are even smaller, $3, or even less, making them super efficient. Now for performance over the year ending the 30th of September 2025, this fund basically did what it was supposed to do. It stayed in line with its benchmark. The report mentions that the Federal Reserve resumed cutting short-term interest rates in September of 2025, which is interesting because they had paused those cuts earlier in the year. This whole period saw market worries about interest rates and valuations, but for this fund, the yield on the 2-year Treasury note barely moved, so it had a minimal impact on returns. That break-even inflation rate the markets guess about future inflation ended the period at 2.42%, up from the start of the year, showing that inflation expectations were definitely playing a role. Looking back over 10 years, an initial $10,000 investment in investor shares would have grown to over $13,000 by 2025. The benchmark index also performed similarly, showing the fund did its job tracking the index. For the 1-year performance, investor shares returned 5.44%, pretty much matching the benchmark. Over 5 years, that is 3.62%, and over 10 years, it is 2.97%. These are solid but not earth-shattering numbers, reflecting a stable performance in a fluctuating market. The fund itself is massive, with $623.76 million in net assets. That is a lot of money, which means it is a really big player in the market. They hold 27 different investments, which means they're not super diversified, but they're focused. Next, we have the Vanguard Emerging Markets Bond Fund. This one is a bit different. It invests in bonds from countries that are developing, which can be riskier, but also offer higher potential returns. For investor shares, the cost of a $10,000 investment was $54, which is higher than the Inflation Protected Securities Fund, likely because emerging markets are more complex to manage. Performance here was also roughly in line with its benchmark. The report notes that while the US Fed held rates steady, global central banks in Europe and England were cutting theirs, which is a big global economic signal. The fund advisor focused on assets in the middle of the risk spectrum like Mexico, Colombia, and the Dominican Republic. This strategy meant they did okay, but some of the really high reward areas like distressed debt would have made them even more money if they had gone there. Since its start in March 2016, an initial $10,000 investment would have grown to over $19,000, surprisingly outperforming the JP Morgan Emerging Markets Bond Index. That is a great sign that their strategy worked well. For the last year, investor shares returned a strong 8.37%. Over 5 years, that is 4.13%. And since its start, that is a really impressive 7.01% average annual return. This fund has delivered solid growth. This fund has $549 million in net assets, so it is a substantial fund though, not as large as the index fund we looked at earlier. They hold 324 different investments, which shows a much wider diversification. The portfolio turnover rate is 119%, meaning they're actively trading and making adjustments. Looking at where their money is, North America is the biggest chunk at 27.4%. Then Asia at 19.8%, followed by South America 20.5%. This shows a truly global approach to emerging markets. Then there is the Vanguard Short Duration Bond ETF. This fund is relatively new, having started in April 2025. For the short period it has been around, it actually outperformed its benchmark, which is a great start. The cost for a $10,000 investment was about $8, which is very low given the short reporting period, and they mentioned it would be higher for a full year. The report highlights that this fund's outperformance came from betting on credit sectors like us investment grade corporates and even high yield corporates. This is a bit more aggressive than just holding government bonds. Since its inception on the 1st of April 2025, the ETF shares have returned 3.81%. This is a short period, so it is hard to draw huge conclusions, but it is a positive start. This ETF is much smaller with only $95 million in net assets. It holds 551 different investments, showing a high level of diversification. The portfolio turnover rate is 110%, which is quite high for a bond fund, suggesting active management in a short duration strategy. The breakdown shows a significant portion in corporate bonds, 49.8%, and US government and agency obligations, 36.2%. They also have exposure to asset-backed and commercial mortgage-backed securities at 13.3%. This mix shows a strategy that is looking for yield in a short duration space by taking on a bit more credit risk. Now let's touch on the auditor's fees. For the fiscal year ending the 30th of September 2025, audit fees were $559,000, which is up from $321,000 the previous year. They don't list any audit-related or tax fees, which is pretty standard for these types of funds. The total audit fees come to that $559,000 for 2025. It is important to see that auditor fees have gone up, but that is often due to more complex regulatory environments or increased scope. Scrolling through the financial statements of the short-term inflation, Protected Securities Index Fund, we see a huge list of US Treasury Inflation Index bonds. This is the core of the fund as expected. The market value of these holdings is massive, over $61 billion. The coupons vary, with most of them being quite low, like 0.125%, with maturities spread out from 2025 to 2030. This shows a laddered approach to manage maturity risk and lock in current yields. For investor shares, the net asset value per S-share is $25.04, which is pretty stable. The total return for the year was 5.44%. The expense ratio is very low at 0.14%, which is excellent and aligns with Vanguard's reputation for low-cost investing. In the statement of operations, we see that investment income was over $1.9 billion, largely from interest. Total expenses were much smaller at around $25 million, leading to a net investment income of over $1.9 billion. The fund also saw significant unrealized appreciation of over $1.2 billion. Now let's check the emerging markets bond fund's financial statements. The schedule of investments here is much more varied, showing a global portfolio. We see us government and agency obligations, but also significant holdings in corporate bonds from countries like Brazil, Chile, Colombia, and sovereign bonds from many more nations. There is a substantial investment in Argentina, for example, with multiple bonds listed. These emerging market bonds carry higher yields, but also higher risks. The total sovereign bond holdings cost nearly $3.5 billion and are valued at just over $3.6 billion, showing a decent gain. The investor shares for this fund have a net asset value per S-share of $10.5. The total return for the year was 8.37%, which is quite good, especially compared to the benchmark's 8.52%. The expense ratio for this fund is 0.52%, which is higher than the index fund, but reasonable for an actively managed emerging market debt fund. Finally, the short duration bond ETF. This fund is very new, so its financial tables are shorter. The schedule of investment shows a heavy concentration in US government and agency obligations at 36.2% and corporate bonds at 49.8%. They also hold asset-backed securities. Within the mortgage-backed securities, we see Ginnie Mae and pools, which are standard mortgage products. The corporate bond holdings alone cost over $46 billion. The fund delivered a total return of 3.81% since its inception, which indicates a positive start in its short operating history. The expense ratio for this ETF is 0.15%, which is incredibly low, especially for an ETF suggesting a very cost-effective approach. Overall, Vanguard seems to be doing what it does best, managing massive funds with a focus on low costs and generally solid performance. The short duration bond ETF is a new player, but it is off to a promising start. The Emerging Markets Bond Fund is showing some impressive returns and diversification, while the Inflation Protected Securities Fund is a steady performer. Looking at these reports, the story is clear: Vanguard continues to offer efficient, low-cost investment vehicles. For the Inflation Protected Securities Fund, it is about stability and tracking the market. The Emerging Markets Bond Fund is showing it can deliver strong returns through active management in a higher risk space. The new short duration bond ETF demonstrates that Vanguard can quickly launch competitive and cheap products. The main strengths are consistently low expenses, strong track records for established funds, and broad diversification where appropriate. A potential weakness might be that some of these funds, like the inflation protected one, are primarily index trackers, so they won't wildly outperform but rather mirror the market. For the emerging markets fund, the inherent risks of those markets are always present, but overall the direction seems to be about providing efficient access to various market segments at a low cost. So what is my take? Vanguard remains a powerhouse in the fund industry, offering reliable options for different investment goals. They seem to be adapting to market changes by launching new products like the short duration bond ETF while maintaining their core strength in cost efficiency and broad market access. The risks are always there with investing, especially in emerging markets, but the data here suggests a well-managed set of funds. What is your take on these Vanguard reports? Do these low cost and steady returns impress you, or are you looking for something more aggressive? Let me know in the comments below, and if you found this breakdown helpful, please hit that like button and subscribe for more deep dives into the world of corporate finance. Don't forget to check out our Discord community linked in the description for more exclusive content and discussions. Thanks for watching, and I'll see you in the next episode of Corporate Decoder.